Financial mistakes to avoid in your early 20s. Entering your 20s is an exciting phase of life. It's the perfect time to build habits that set the foundation for a lifetime of financial security. However, this decade is also when many people make costly mistakes with their money. Here are some of the most common financial mistakes people make in their early 20s and how you can avoid them. 1. Failing to create a budget. Creating a budget is one of the first steps toward financial independence, but many people overlook its importance. Without a budget, it's easy to lose track of spending and fall into debt. Why this happens? Lack of financial literacy. Overestimating how much money is available for discretionary spending. Thinking budgeting is time-consuming or unnecessary. How to avoid it? Use budgeting apps or tools to track your income and expenses. Stick to the 50-30-20 rule. Allocate 50% for needs, 30% for wants, and 20% for savings and debt repayment. Regularly review your budget to adapt to changes in your income or lifestyle. 2. Overspending on lifestyle choices. Your 20s often come with newfound freedom and independence. The temptation to spend on eating out, travel, and trendy items can easily lead to financial strain. Consequences: accumulating credit card debt, reduced ability to save for future goals like buying a house or starting a business. How to avoid it? Set spending limits for non-essentials. Prioritize experiences over material possessions. Delay gratification by saving up for big-ticket items instead of buying on impulse. 3. Avoiding or delaying savings. One of the biggest financial mistakes in your 20s is assuming you have plenty of time to save later. This mindset causes many people to miss out on the power of compound interest. Impact of delaying savings: smaller retirement fund by the time you reach your 60s. Greater financial stress during unexpected emergencies. How to avoid it? Start saving a small portion of your income, even if it's just $50 per month. Open a high-yield savings account for your emergency fund. Begin contributing to retirement accounts like a 401k or IRA if available. 4. Accumulating credit card debt. Credit cards can be a useful financial tool, but they can also lead to a spiral of debt if misused. Many young adults fall into the trap of using credit cards to fund a lifestyle they can't afford. Common mistakes: paying only the minimum balance, using credit for unnecessary purchases, ignoring high interest rates. How to avoid it? Only use credit cards for purchases you can pay off in full each month. Focus on building a positive credit history by making on-time payments. Avoid carrying multiple credit cards if you're not confident in managing them. 5. Neglecting to build an emergency fund. Emergencies are unpredictable, but many people in their 20s don't prioritize creating a financial safety net. Without an emergency fund, even small setbacks, like a car repair or medical bill, can lead to financial stress. Why this happens? Belief that emergencies are rare in your 20s. Focus on short-term wants over long-term needs. How to avoid it? Aim to save 3 to 6 months' worth of living expenses in an emergency fund. Automate your savings to make it consistent and easy. Keep your emergency fund in a separate, easily accessible account. 6. Not investing early. Many people in their 20s assume investing is something to worry about later in life. However, starting early allows you to take advantage of compounding returns, which can significantly grow your wealth over time. Common mistakes: waiting for a higher income to begin investing, assuming investing is too complex or risky. How to avoid it? Start small with index funds or ETFs, which offer diversification at low costs. Use apps that simplify investing, like Acorns or Robinhood. Focus on long-term growth rather than trying to time the market. 7. Ignoring student loan debt. If you have student loans, delaying payments or paying only the minimum can be a costly mistake. Interest accumulates quickly, increasing the total amount you owe over time. Impact of neglecting student loans: difficulty qualifying for other loans due to a high debt-to-income ratio. Paying significantly more in interest over the life of the loan. How to avoid it? Make extra payments whenever possible to reduce the principal amount. Refinance or consolidate loans if you can secure a lower interest rate. Explore repayment programs or forgiveness options if eligible. 8. Skipping health insurance. Many young adults assume they don't need health insurance because they're healthy. However, a single medical emergency can result in thousands of dollars in bills. Why people skip it. Perception that premiums are too expensive. Belief that they're invincible. How to avoid it. Take advantage of employer-provided health insurance if available. Explore affordable options through marketplaces or government programs. Consider catastrophic insurance plans if you're on a tight budget. 9. Relying too much on parental support. While it's common for young adults to rely on their parents for financial help, overdependence can hinder your financial independence. Why this happens. Lack of financial education. Fear of taking responsibility for personal finances. How to avoid it. Set financial boundaries with your parents. Take ownership of your expenses, starting with smaller bills like your phone or car insurance. Focus on building a sustainable income through work or side hustles. 10. Underestimating the importance of financial education. Your 20s are a great time to build your knowledge about personal finance, yet many people don't take the time to learn. This can lead to poor decision-making and missed opportunities. Common oversights. Not understanding the basics of taxes, investing, and credit. Trusting unreliable sources for financial advice. How to avoid it. Read books, listen to podcasts, or take online courses on personal finance. Follow reputable financial experts and resources for reliable advice. Regularly update your knowledge as your financial situation evolves. 11. Not setting financial goals. Without clear financial goals, it's easy to feel aimless with your money. Goals give you direction and motivation to save and invest wisely. Why goals are important. They help prioritize spending and savings. They keep you accountable for your financial progress. How to avoid it. Break goals into short-term, 1 to 2 years, medium-term, 3 to 5 years, and long-term, 5+ years. Track your progress to stay motivated. Adjust your goals as needed, based on changes in your life circumstances. 12. Spending without thinking about retirement. Retirement may feel like a lifetime away, but the earlier you start saving, the more comfortable your retirement years will be. Why it's overlooked. Focus on short-term needs and wants. Belief that there's plenty of time to save later. How to avoid it. Contribute to retirement accounts like a 401k or IRA, especially if your employer offers matching contributions. Aim to save at least 15% of your income for retirement. Reevaluate your retirement strategy as your income grows. 13. Falling for get-rich-quick schemes. Many young adults are tempted by opportunities that promise fast returns like multi-level marketing, day trading, or unproven investments. Why this happens. Lack of experience and financial knowledge. Desire for instant gratification. How to avoid it. Be skeptical of opportunities that sound too good to be true. Focus on building long-term wealth through proven strategies. Consult with a trusted financial advisor before making risky investments. Final thoughts. Your early 20s are a time of exploration and learning, and making some mistakes is inevitable. However, by avoiding these common pitfalls, you can set yourself on a path toward financial success and stability. Take small but consistent steps, and your future self will thank you. Building strong financial habits now will pay off for the rest of your life.